Hello, everybody. Welcome back to Stewarts Soundbites. This is the first of a special kind of two-part mini-series of Stewarts Soundbites, and this episode and the next one is dedicated mainly to those people who are acting as property and financial affairs deputies, probably on the larger catastrophic cases that the type of cases that we deal with, where the compensation is usually significant. I'm really happy today to be joined by Mark Holt, who is an IFA, an expert reporting to the court on form of awards, and the COO of Frenkel Topping. So we're in good hands today. We've got an expert. So hello, Mark, and thank you so much for joining us.
Thank you, Emma. Absolute pleasure to be here. Very grateful for the invitation, the opportunity to talk to you on this subject matter, and to hopefully be part of what has been a very successful rollout of your Soundbites.
If we just start off, Mark, we're talking, first of all, a little bit about PPOs versus lump sums. And I want to start kind of on a basic level and ask you, in your capacity as an IFA advising on form of award, are there cases that just kind of land on your desk and you think this is an obvious PPO case? And if that's right, what are the key features of those sorts of cases?
Okay, it's a really interesting question to open up on, because I think we should really revisit the principles of a periodical payment over and above a lump sum, and the key benefits of it. So there are cases out there that quite simply don't need an IFA input on them. So if they are non-capacity cases, there are large future recurring losses to account for, and there's very little contrib on the case. Then there's lots of seasoned practitioners and litigators that would know that really, do you need an IFA to say that this should be a PPO case? And what's happened over recent times, of course, and I'm going back to 17 and from 17 onwards, was a significant shift in one of the major factors that's played an impact on how many cases settle with a periodical payment and don't, and that is the change in the discount rate. So if we go back to 2017, when the discount rate was 2.5%, then we were instructed much more often to give advice on periodical payments, because at a 2.5% discount rate, your multiplier at that rate would have been significantly lower than when it changed dramatically. And I think we can all remember the day that it came out as a negative 0.75%. I think the insurance industry reeled back in shock and horror.
Yeah.
And for the reason being, quite simply, you take a 45-year-old male at that time on a 2.5% discount rate with normal life expectation, his multiplier would have been somewhere in the region of 24, 25 maybe.
Yeah.
Literally overnight, that multiplier went to 47. So if you take a future recurring loss of, let's say, £100,000 for simple terms, you were arguing at the point on should that case be a periodical payment or not, giving them £100,000 a year or £2.4 million. And very often was the case when you factor in various things, which I'll touch on with you shortly, taxation, indexation, investment returns, etc. It was very easy to prove that taking £100,000 was a much better option for the claimant than taking £2.4 million. Try having the same conversation when that £100,000 PPO is now replaced by £4.7 million. So obviously it became much more attractive to the lay client, not necessarily so for capacity cases, because of course under CPR 21 practitioners should always get a financial report to put towards the court. That, I have to say, isn't always the case that happens, but it should. So it was quite obvious in some of these cases that come across our desk, if you've got large future recurring heads of damage and very little contrib, it should be a PPO case. Now, I've got some data I can talk to you about that is predominantly based around road traffic accidents and severe road traffic accidents, and we can analyse the decline in periodical payments and the propensity of periodical payments. But even for those practitioners who are involved with clinical negligence and dealing with the NHSR, just to give everyone a flavour who might not be aware of the kind of scale of claims that come out of NHSR, last year, looking at their accounts, they paid out £2.4 billion in compensation for medical negligence, upheld medical negligence claims. That's about, I think they closed off about 15,000 claims in the year. So 10,000 of those claims they actually paid out on. Now, of those claims, 10% of them were obstetrics. But of those 10%, that accounted for 50% of the compensation that was paid out to claimants.
Wow.
Now, as we know, they were primarily be birth injury cases. And as we know, in those cases, most of the time there are significant future recurring needs for care and case management. So you get a much less pushback on periodical payments when it's an NHSR defended case, particularly for infant birth injury cases. So I mentioned with regards to the discount rate, and it's really important for everyone to understand how we've ended up with this discount rate that we have today. And then I'll talk to you about propensity in RTA and the more severe end of RTA cases. But just to remind everyone how we've got a discount rate of 3.8%. So there's lots of consultations that went on that has ended up now having a rate of negative 0.25%. So it assumes that a claimant, and rightly so, when you look at the research that went into it, wouldn't just invest in index-linked gilts, because no one ever just invested in index-linked gilts.
Yeah.
So it was a sensible forward move to look at an alternative way of setting the rate. The upshot of it was that they assume that people are now going to get a gross 3.8% return on their money when they invest their damages. That is made up then of the fact that there's a 30-year average of RPI, so inflation, at 2.8%. So that brings us down to 1%. Of the 1%, they assumed a 0.75% adjustment for taxation and investment management charges, which, in my opinion, and that of many people who operate in this marketplace, is woefully low. But they do actually recognise, and I say they, I'm talking about the government in the technical memorandum, that the rate that they set at 3.8% was on basis of a static portfolio. So didn't include active management of that portfolio, which is quite pertinent to the next subject we're going to touch on in a little while. And then there was another adjustment of 0.5%, a prudence adjustment on the basis that that was a Lord Chancellor overview. So that gave us a negative 0.25%. If we just pause there for a moment, that actually, now, if we just take stock of that, means that it is assumed that everyone invests money at 3.8% is going to lose. So they're losing money every year. So there's lots of cases at the moment are settling where it is assumed that the lump sum is more than enough. But I've got lots of examples, and we've got one where the future costs were £40,000. The individual had a long life expectation. The £40,000 capitalised was circa £2 million. So we cash flow modelled the £2 million, assuming that you had to pay out £40,000 a year with appropriate indexation, care and case management, which I'll come on to in a minute with regards to the difference in the uplift, factoring in taxation, which again is another really important bit that we'll touch on again. And the award of money didn't last because taxation is going to be greater and indexation is going to be larger than the 2.8% or the 0.75% that's built into the discount rate for settlement. And it didn't last by 7 years. And I'm just going to remind myself, I think the rate that was required was 4.25% rather than 3.8%. So immediately your claimant is having to take more risk, even on a non-contrib case, with a sum of money that they believe is more than enough to cover that future recurring cost. Where it becomes really interesting, Emma, is when you look at the stats that comes out for ASHE, so the index that they use to increase future care and case management. So I'm going to come back to the discount rate again. So it's assumed that inflation is 2.8%, but the average increase across the piece, across all the percentiles that comes out every year from ONS, the average increase for ASHE over the last 5 years has been 4.36%. So not 2.8%. So that's a 1.56% increase in inflation over and above that used to calculate the discount rate. So when you start factoring that in versus the lump sum versus an indexation, then you start seeing why actually more cases today should get professional analysis, whether it be us or other very experienced practitioners. I would urge people not just to settle cases on the basis that the lump sum seems to be enough and should more than cover, because it's assumed that you've got more than the actual recurring cost. Because the other thing that's really important to note is taxation. So we have gone through a fairly horrendous time recently with regards to COVID. And I'm not sure everyone's aware of the numbers, but in 2020, the government borrowed 300 billion. It's set to borrow a further 200 billion this year just to cover furlough. And the knock-on effect of that, even though the government said when they came into power that they would freeze tax on income tax, NI and VAT, the latest statement says that everyone's going to have to pay for it. It didn't include capital gains tax. And anybody that invests money is going to pay capital gains tax.
Yeah. It's a bit frightening, Mark, when you put it like that, but it brings home, the serious implications, and, really having to apply ourselves to these questions. And I wanted to turn it on its head a wee bit and look at it from the kind of opposite perspective, because we're talking about kind of lay clients and things, and from a claimant's perspective here. But I wanted to talk a little bit about the insurers really, and the trends. You're talking there about kind of the prevalence of lump sums and people thinking, this is plenty of money to do me. Is there a shift away now? Is there a clear kind of shift away from PPOs to lump sums? And have you identified a trend that insurers are disinclined towards PPOs?
Yeah, well, we subscribe to the data from the Institute of Faculty of Actuaries. So we get a lot of data that's actually made up of the 13 main insurers and the 6 main reinsurers. And if you again, going back to 2017, beginning of 2016, you had circa 120 serious cases, 120 cases over £1 million in RTA. And the propensity of those to settle with a PPO was 25%. The discount rate hit. The cases remained about the same, but the propensity dropped to about 7.5%.
Right.
So there's a big shift. Now, that is because A, it's more attractive to the claimant to take the larger lump sum, but B, the insurers, and I've sat in many JSMs, start from a position that this is not a PPO case, because ultimately their underwriters, their actuaries in the background are telling them the way they have to reserve for this ongoing debt under Insolvency II rules is their reserves are astronomical. So what they want to do in any effect, and I've been involved in, like I say, many situations where this has happened, insurers just want to buy off that liability. They don't want the long-term liability of having a PPO on their books. So, I'm sure there's many people on this call and many people who listen in the future will have an experience of the same thing, where the insurer will say, what's it going to take not to enter a PPO? So that, like I say, their starting position in the main for mine, and we do ask for some insurers as well, because we do some defendant work, but they come to us and ask us the same question. They don't really ever want to enter a periodical payment unless it's a cut and dried case that quite clearly has to be a PPO.
And sometimes this is the last question on this topic, actually, Mark, because time just flies on these, as you'll see. But is it sometimes therefore necessary for us to say at JSM, if the insurers are saying absolutely no way, we're not doing a PPO, is it then necessary sometimes to go on to trial to get that PPO?
I'm going to answer this really quickly for you, because this is a huge subject, and I could talk to you for over an hour on this. There are huge cost implications. I think the threat of going to trial might get what you want from the defendant, because obviously there's cost implications. I've posed the question many times that if the insurer isn't offering a PPO, but your claimant wants a PPO, then really an offer should be put to them. And if they can't beat the offer, there's cost implications under Part 36. The difficulty is, as the case progresses, and this is where you've got liability risk, or you've got litigation risk, with regards to if you then pursue the case and your claimant gets better in certain, and you might win on some heads and lose on others. If as a global settlement you don't beat that offer that included PPOs, the cost implications are massive. So it's a huge risk. But ultimately, what I would urge listeners and practitioners to do, under CPR 2, the court has a duty to consider the form of award and still does hold the powers to impose periodical payments. So one should never forget that. Yeah,
for sure. Okay, the second half of this talk, Mark, we're going to shimmy along to it. Is we're talking about kind of management of funds post-settlement. What is the thought process for deputies when they're deciding whether to actively or passively manage funds? And is there a sweet spot? Is there a way of combining the two in a middle ground?
Okay, again, super question. We have long since advocated that deputies, that's beyond the remit of a deputy's decision. So if we go back a step and understand, and the deputies on the call will really fully appreciate this, there's a thing called the Deputyship Standards. So the Deputyship Standards was developed by professionals and public bodies, and the standards fall into various different categories, but one is securing P's finances and assets. So in terms of that, clear guidance is always set out in the court order, and that will usually state that a deputy for property and financial affairs should obtain and take into account proper advice from an experienced financial or investment manager. Okay, so unless a deputy actually holds the qualifications as a financial advisor or the investment management certificate, that's a decision that's beyond their expertise because it's a skill set in its own right. And sometimes deputies do choose to go to just a discretionary fund management business because they believe that's the best one. In effect, they're acting as a pseudo financial advisor because they're making the conscious decision that they believe that's the right investment house. The role of the IFA is to protect the deputy and P ultimately by cash flow modelling, tax planning, which we'll talk about in episode 2, offshore bonds, etc., where there can be huge savings to the claimant, annual reviews, and a lot of deputies remove the IFA because they're looking to save that cost, whereas actually the cost could be hugely saved by involving them and having them involved in a review process. So my take on that is that deciding whether you should invest P's funds in passive or active is not a decision for the deputy per se. It's a decision for the investment manager or the IFA working with an investment manager.
And presumably there are key markers indicating to the IFA or whoever's dealing with it when investment strategy should change.
Absolutely. That's what you're paying for. So whistle stop tour, because I know we're very short on time now, but whistle stop tour. The difference between passive and active. Passive is low cost, no intervention, and will track an index. Whereas active, of course, is the opposite of that. You've got the overlay of a manager making decisions on that fund. I'm going to give you 2 examples as to 2 passives as to where you can and cannot beat the index. So if you take the passive tracker that tracks the S&P 500, in the last 5 years, there's only been about 15% of fund managers have been able to outperform S&P. So if we get our head around that, that means 85% of active fund managers can't beat a passive tracker. So in that instance, you would say all day long, have a passive.
Yeah.
On the flip side of that, the MSCI Emerging Markets Index, which would be a passive, that over the last 3 years, that's only performed at 4%. Whereas people like BNY Mellon and JP Morgan, they're looking at between 26 and 30% returns over that same period. So you can see in that regard, you would always have an active over a passive. The solution somewhere in the middle is have a portfolio built up of active management and passive management.
Yeah.
So you get the passive will introduce an absolute level of low cost. The active management as an overlay is there to protect you from the downside. So if we go back to why you should have a PPO, and I mentioned it earlier with regards to investment returns and volatility, we've all been through an absolutely horrendous ordeal of the last 18 months. None more so than those people that may have been in a passive if they were in passives only back in the beginning of April last year, when markets fell by over 35%. So if you're in a passive, you are absolutely nosediving 35% because there's no downside protection. The idea of having a proper discretionary fund management portfolio is you would hedge against those by having active overlay. So for example, when that market fell 33%, our portfolios fell on average about 10.
Yeah.
So that's the benefit of having active overlay, but including some passives. And again, we could speak for hours, as we did a few weeks ago, Emma, on this subject matter.
Yeah, I know. But thank you ever so much. As always, we're out of time far more quickly than I would like. Thanks, Mark.
Thanks very much. Thanks, Emma. Thanks, everybody.